Let's go out to our Smith Futural headquarters where we find Fabio Clips. Welcome again, Fab. Taking into account the obvious complexities, I would love you, in simple terms, and I reckon I'd have plenty of company here, to explain negative gearing for us. You know, what are the advantages with it and what are the disadvantages with it as well?
Look, negative gearing's obviously a term that gets bandied around a lot when we talk about property investments, and it's a pretty simple equation. I mean, it's effectively a situation where if a property investor's borrowing to invest in a piece of property, the rental return that it's generating on an annual basis is basically less than the interest that's being paid on the debt. Okay, that's a situation where what we refer to as accountants, where you've got a negative gearing scenario. The big advantage of it is obviously that when you do make a loss for tax purposes, that loss can be deducted against the investor's other income, and you effectively get some sort of tax benefit. Now, how high that will be will depend on everybody's individual circumstances and the applicable rate of tax that they're paying. But it can be as high as 47% of the amount of the loss that's being made on the rental property. It probably leads into the question that if you are negatively geared, what's the benefit of doing it from a wealth creation point of view? And the theory is that you're doing it purely simply because while you're getting those tax benefits each financial year as you own the property, the theory is that the underlying value of the property is going to, over the term of ownership, is going to exceed the accumulation of all the losses that you've made after you add back in your tax benefits that you've received. Obviously, positively geared is just the opposite scenario, whereby the rent exceeds the amount of interest that you're paying on the borrowing that you've incurred to buy the property. That's simply all that we're talking about.
Fab, lots of people hold off on selling for lots of different reasons. One of those is capital gains tax. Can you explain to us, again if you can, in simple terms, what this all means and how it can affect a sale or the timing of a sale?
Look, the big issue with capital gains tax is that there's different rules that apply to different types of structures through the Australian economy. So what happens for an individual that holds property might be different to, say, someone who's holding a property in a company or in a trust structure. So simply all you've got is a situation where if you've acquired an asset or, in this case, a property, and at some point later on you go and sell that, depending on what you end up with out of the sale versus what you paid to acquire the property, you end up with a capital gain or a loss. Okay, now the big one here is that we do get some pretty serious tax concessions as individuals if we make capital gains, and effectively they kick in after you've held an asset for more than 12 months. As an individual, you hold an asset for more than 12 months, what comes into play is what we refer to as the capital gains tax discount, which effectively means that whatever the gain you made on that property when you sell it, you're only going to pay tax on half of that gain rather than 100% of it. So you're effectively paying half the rate of tax on the profit that you've made.
I was just going to ask you, sorry there, Fab, just for investors who might be watching tonight as well, your advice to them from your perspective and around things like depreciation schedules and the like, is that something that people should be obtaining?
Yeah, look, 100%. I mean, we recommend to all of our landlords that they do go out and pay the money to get a quantity surveyor who's qualified to give them a depreciation schedule. The reason we do that is depreciation and the ability to write off the original cost of the construction of the property that they own it can be a huge tax benefit over the period of ownership of the property. So we think that whatever fee they incur for getting those depreciation schedules, they're actually going to get back that and more through the tax benefits they get by maximising their deductions. If they don't go and get those, their deductions going to be actually very, very limited in terms of what they can get in terms of depreciation and that capital allowance, which is the original construction cost of the building.